Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. A year of market worries, along with many other concerns across the globe, led somehow to a year of outstanding market performance for many investors. The Mag 7, gold, and Bitcoin took top of the leaderboard, but many other areas of the global markets performed exceedingly well in new regions and with some renewed interest in old sectors due to expected AI revivals or complete disruptions to almost everything. So how does the groundwork laid in 2025 help investors turn the page into a new year with 2026 just days away? Will portfolios need leadership change or to factor in new factors or to hold fast to the traditions of a 60-40 portfolio? Happy to say joining us here today for his final live Fidelity Connects webcast of this year is Fidelity's head of global macro, Jurrien Timmer, joining us from Europe. Welcome, Jurrien. So glad to see you. How are you?
Nice to see you as well. Greetings from my mom's kitchen table, which we've been doing the show from for a few times now. So
well, it feels like home, and I always think that the smells around you are probably absolutely delicious and mouthwatering. In any case, we have you here. Delighted to have you here. Let's go through some of the backdrop that has been created through 2025. There's a lot of it. You'll chunk it out for us in different pieces, but. Is concentration risk sort of what we're left with in December? Is this the question, really?
it's certainly one of the big ones. And actually, let's pull up slide one first. So the way I look at it, and I've been writing about sort of lines in the sand, not only cyclically, but also secularly. And what we think about is, of course, the AI boom. Does it turn into a bubble? Does it not? And I'm increasingly of the view that actually it's not, because there is now so much scrutiny and skepticism about, the circularity of vendor financing and the quality of earnings with depreciation schedules, et cetera, that I'm actually starting to feel better that this is not going to be a bubble and that there's enough scrutiny from investors that sanity will remain in the markets. Um, but the Mag 7, and actually we can go to slide 8. Let's do that. The Mag 7 is a good chunk of the markets, and they of course have propelled the markets higher, and that's a good thing because they've amplified returns. I mean, the S&P cap weighted index this year is up 18%. The equal weight is up 11%. So that kind of tells you the difference there. And from when the cyclical bull market began, the cap weighted index is up close to 100%, and the equal weight is up about 58%. So it shows you the magnitude of the Mag 7, no pun intended. And concentration risk obviously is something we need to think about, especially as we are hoping for sort of this AI dividend to spread to the rest of the market, right? And that's been a story of the last few weeks. And we can go to well, let's go to slide 3 first, and that shows the power of earnings for the Mag 7. And you can obviously see the story that they're up 4 or 5-fold over the past 3 years, largely propelled by earnings. So that's been a very good story.
So if you look there, 4, just quickly, you go back to 2020 and it's at 208. And now where we are, that it's just extraordinary to think. The 2020 was not that long ago. It was pre the slide that we saw in 2022, and still that's what's managed.
Yeah, and actually, I'll show you a new geeky chart that I just made, slide 1, that shows the return of the various asset buckets that I track since the October 2022 low. And you can see that the blue dots are the Mag 7, and you can just see how much they've powered ahead. So that's been a very, very big story. But it can cut both ways, right? They can drag the index higher when they go up, but they can also drag it lower when they go down. And one of, I think, the big questions for 2026 is, can the baton be passed, or can the market broaden without the Mag 7 taking the index down if you do have that rotation? And I don't have the answer to that, but if we go again to slide 4, we can see that the 493,
right,
the rest of the market, are getting really good support now from accelerating earnings estimates. And whether that is a downstream AI dividend or whether it's just the one triple B the fiscal bill, whether the capex expensing is lifting that, or whether it's just the economic cycle or deregulation. But the good news is that the rest of the market is waking up in terms of its fundamentals. The question is, if the AI leadership goes downstream and the emphasis goes from the providers of the picks and shovels or the rails, if you'd use a railroad analogy, to the users of AI, what happens to the index? Like what happens to the beta that is in the market? And that's a question we don't have an answer to. But with the concentration being this high, I fear that even if all the good things happen that we hope for, we may not have much to show for it in a passive kind of index environment. And so that's something I struggle with.
I mean, you've mentioned in notes the term scarcity. So if a rotation wants to happen out of some of high flyers, but probably well valued, it's an argument, for the Mag 7 into kind of everything else, which is the discussion. Is there enough of everything else for that flow to happen?
That is a good question. So tech and telecom alone are 43% of the S&P 500 today, which is what it was back in 2000. And I don't mean to overplay the 2000 analog. I do think the market is much, much different in many ways, in many good ways. But it just shows you, it does show how concentrated just those two sectors are. And that doesn't even include like a consumer cyclical sector, which has Amazon, so
Right.
it's actually even more concentrated than that. So yes, but your question speaks to that concentration risk, that if you go from a handful of super large stocks to a smaller pie of many other stocks, what happens to the index? And this is why I've liked kind of the international barbell approach, right? I mean, by the way, cap weighted index up 18 this year. MSCI ACWI ex-US is up 35 this year, right? So,
Yeah.
and that's why I continue to like this notion of having a more globally oriented portfolio for a change, because you don't have to choose between the Mag 7 or growth and value. Like it's not a zero sum. You can have a little bit of both and have both the cap weighted S&P and something other than US equities, so that if one does falter, the other one hopefully picks up the slack.
Well, let's talk a little bit about that and ultimately what needs to backstop, or certain premiums that are going to be charged ultimately because there's elevated risk on this side of things. I guess the question is, for equities, is there risk across the board, which is exactly what you're addressing, regardless if you're in equities in Europe or Japan or wherever? Is there sort of an equity premium that we need to talk about here?
Yeah, so let's first go to slide 17, and I just want to highlight the power of the story for non-US, at least developed stocks. Emerging market stocks tend to dilute shareholders just because they're emerging, they're issuing shares. But in this chart, we can see obviously the US story, the buyback story, and how the net issuance of US companies has gone down over the years, over many years. But in the orange, you can see what IFA is doing, so non-US developed, and they're shrinking their share float, if you will, faster than the US. And
With
to me, this is
buybacks? Is that with buybacks?
these are buybacks, yeah. So the dividend story, is evolving as well, because companies are paying more dividends, but it's mostly the buyback. So companies in the developed markets have finally really gotten the message that they need to cater to shareholders, and whether that's philosophically right or not is another story. But they have gotten much more shareholder savvy, and they're unlocking essentially dormant balance sheets by buying shares, paying dividends, and their payout ratio. So the ratio of dividends and buybacks as a percent of earnings is now 75%, which is where the US is. And so it's a much more level playing field, even though the earnings story isn't as interesting.
Mm.
But the amount of balance sheet and earnings that they are monetizing for shareholders is a really, really big shift. And remember, IFA's trading at 16 PE,
Right.
the US is at 25. So if you get equal fundamentals and a much lower PE at a time when you have concentration risk in the US, to me that's a pretty good message to say, you know, paint the global stock market with a broader brush this time, which would be a departure from the last 16 years where the U.S. just completely dominated.
And just to add into that, the EM trade, which has done incredibly well this year, there's seems to be a lot of different discussions around it. If you look at the balance sheet of certain countries that were in the EM index, I don't know, pre-COVID, they're very different stories. I mean, they actually are, the countries themselves are in better shape. Does that allow for some sustainability on the EM front as well, EM equities?
Yeah, absolutely. And EM has been a good story. It's, of course, a more fragmented
Yeah.
story. You have China on one hand, India on the other. IFA, same thing, right? You have Europe and Japan for the most part. But the value proposition is different, right? So in Europe, you're getting not great earnings growth, but you're getting this unlocking or monetizing of balance sheets and income statements. So you're getting the financial engineering part, I guess, if you will. EM is more earnings growth, an more interesting, obviously, secular growth story. It's cheaper, right? So the way I think of it is if you plug this into a discounted cash flow model, what you're doing is you're plugging in the expected earnings growth, which we can get from our Bloomberg or FactSet or what have you, and then you assuming that the current price is the correct one, you're solving for the required return in that DCF. And so for the US, the market is pricing in 11% growth, 12% growth. The required return is about 8%. So then you subtract the 10-year treasury, you get an equity risk premium of about 4%. In IFA, the number is the earnings growth is only expected to be about 8.5%, and the required return is higher, so the risk premium is higher. And in EM, the market is pricing in about 14.5% earnings growth, but at a required rate of like 11%. So the risk premium is high and the earnings expectations is high. So if those expectations come through, EM is a really great story.
So should it be not correlated? I mean, should EM really stand up? I want to talk a little bit about what's correlated
Yeah.
and what isn't, because you later on talk a little bit about sort of hedging your portfolio. But is EM a proper diversifier? I know it's still equities we're talking about right here, but
Yeah.
they have different markets, different, often domestic markets.
So why don't we pull up slide 16? I know we were going to get to that later, but so what I've done here, I'm showing the 5-year correlation
Oh, great.
of all the different asset classes that I track, from stocks to bonds to alternatives. And on the horizontal axis, I show the correlation to long bonds. And on the vertical axis, I show the correlation to the S&P 500. And what you can see is three kind of well-identified asset class buckets, basically. Way on the right, of course, are the bonds. They're highly correlated to bonds. They're somewhat modestly correlated to equities. They used to be negatively correlated. Then you've got all the various equity buckets, and then you have the kind of what I would call the diversifiers, which includes gold, I would say Bitcoin, liquid alts, commodities, cash, etc. So if you look at the upper bucket, you can see that MSCI EM is actually one of the least correlated buckets. And actually, if you go to the yellow bucket, MSCI China, it's not uncorrelated, but it's only about 20% correlated. So you do get into less correlated areas once you get into the EM story and you get into more to the more idiosyncratic parts of the world, right? Because China is now so decoupled from the developed markets that it kind of does its own thing.
Right, that's fascinating.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of Fidelity Connect's podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to Fidelity Connect's, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
So just in terms of diversifiers, tell us a little bit about taking a look at a 60-40, which has been discussed a lot this year by you. You've put suggestions for different things that could go on the 40 side of things. But as we approach 2026 and want to get stuck in about correlations, what is correlated, what isn't, tell us a bit about the 60-40, perhaps its evolution.
Yeah, so let's go to slide 15, and we've talked about this in the past. But again, I look at the cyclical time frame, right? Basically the next year, and I'm getting the feeling that the economy is actually going to start running hot again. The U.S. economy. There's lots of concern about unemployment, et cetera, but we got some animal spirits going.
Right.
We got the fiscal bill. We got the AI story. We now have a Fed that is becoming more fragmented and soon will probably become more dovish. You have a Treasury Secretary that I think, in conjunction with a friendlier Fed chair, will try to unlock bank balance sheets as well, right? If they steepen the yield curve by lowering short rates, even if the bond market doesn't agree with that and you have a bear steepener, and at the same time the Fed deregulates the banks, which Treasury Secretary Bessent is all in favor of, then you could have a situation like the 1940s where the Fed engineers a steep yield curve and gives the banks every incentive to load up their balance sheet with treasuries. So, as well as loans, right? Because
Sure.
if you deregulate the banks, they're going to expand their balance sheet. So you add all of these things together, and you could argue that 2026 could actually have a fairly hot economy. And so, again, coming back to slide 15, so how do we deal with that, right? So again, we mentioned concentration risk. We mentioned a broadening to the 493, but that it might come at the expense of the beta that the S&P can generate. To me, that tells me a more global approach, like we just discussed, especially EFA, but also EM. Then on the bond side, if the Fed gets too easy, and if we look at current expectations for Fed policy, the market is expecting about a 3.1% Fed funds rate over the next year or so. Our star is about 1%. Inflation is 2.5 to 3, so that would suggest that the Fed would be quite accommodative at a time when it's probably not warranted, and that would presumably bear steepen the curve, lower the dollar, and so how do we mitigate against that? And I've been talking about the 60-20-20 as the replacement of the 60-40 for some time, and to me that's still the way to do it, because if that bear steepening happens, and bonds are at 4.15%, maybe heading back towards 4.5 or 5. I want to have some bonds, but I don't want to have a lot of bonds, and I want to have assets that protect not only against the 60 but against the 40, and that's when you get into these other alternatives like commodities, gold, Bitcoin. Even cash. Cash has been a star performer, and then various other alternatives.
So, including things like Bitcoin. I wonder if we
Yes.
can bring in the conversation of cryptocurrencies broadly. Bitcoin has had an absolutely wild ride over the last couple of months. There have been a number of reasons for those. We've depended on you to take these deep dives for us for some time now. How do you think it's sort of traversing right now, but maybe a bit more into the future? There's a lot of competition in theory on the crypto side.
Yeah. So my sense is, gold is actually making new highs again today. And I know you asked about Bitcoin, but I can't talk about one without the other. But, gold is doing a very high level consolidation. And whenever a very strong rally starts to correct, but it does so without a lot of price damage, it tells you that that's a bull market, that the underlying trend is very strong. And so gold is displaying all of those attributes. And so I want to be long gold. I don't think it's going to repeat what it did this year, but I don't want to, I want to maintain that in that alternatives bucket. Now, Bitcoin on slide 20, my guess is it's going to take a year off next year. So remember, it made a new all-time high as recently as October at 125,000. Even though most of the year it's kind of like been sitting around. Remember, after the election last year, it really ramped up. It went to 100,000 plus. Michael Saylor ended up inviting us to his New Year's Eve party in Miami Beach because it went to 100,000. And then, you buy the rumor, sell the news. And then earlier this year, it kind of started to churn. And then we got that whole Bitcoin treasury financial engineering machine going. And we're kind of, I think, maybe getting to the tail end of that. But it's interesting, I'm not a Bitcoin pro or a Bitcoin native, but I look at the halving cycles, which are 4-year cycles, right? So Bitcoin goes up for 3 years, it goes down for 1. And in this chart, you can see in the green all of those bullish waves, and in the red, all of the bearish waves. And when I line up all the bullish waves and I get to where we got to recently, it kind of looks like there's some harmony there or some symmetry there. And you can actually create a regression. Actually, if we go to the next slide, you can actually create a regression of the time that each wave lasted and the amount that it appreciated. And that gets you to kind of a sense that 125 after 145 weeks was a little shorter than it should have been. It should have been 150 over 160 weeks. But we broke that last trend line. We got down to 80,000. We're at 89,000 today. And so to me, it kind of feels like we're in one of those drawdown modes. And that would suggest that we're going to spend at least part of 2026 kind of going sideways. I see strong support at 65,000, which actually is not that much lower than the 80,000 we already saw. And if that leads to the next upwave, based on the curvature of those waves and the mathematical relationship of those waves, we should go from 65,000 to about 300,000 by 2029.
Wow.
And so I'm still a secular bull, but these things can't go up all the time, right? And it's funny because, again, I'm no halving wave expert on Bitcoin, but whenever Bitcoin goes up in one of those waves, all the Bitcoin pros on Twitter will tell you that's the halving cycle, and yeah, you got to be in. And now that I posted this on Twitter last week, they're all saying, well, the 4-year cycle is dead. There's now a super cycle, and you don't know what you're talking about. And so like the talking the book part is very convenient. Happens in every asset class. I don't need to pick on Bitcoin, but to me that wave structure in that chart looks, like I don't want to ignore that. Maybe it's wrong this time, but to me it looks compelling. And so to me, if it's a question of do you want to hold a marginal long position or a really big long position, to me, the answer is the former for now, because to me, this does not look like it's going to moon again, at least over the near term. I'm happy to be proven wrong, but that's kind of how I'm reading the tea leaves.
Fantastic. There's a question about trade. This is an awful lot of what Canada has to look forward to next year. Look forward to, you might take that a couple different ways. But in any case, the question is, what sort of variability do you see in possible outcomes with respect to trade tensions or deals regarding the USMCA and sort of the North American story? We're seeing lots of geopolitical discussions in South America. Some will say there might be a place for a all America's trade deal at some points, North and South and Central. But yeah, if you could just sort of couple of thoughts on trade for North America. What are they?
Yeah. I mean, to me, it's the biggest no-brainer ever, right? So I can understand that if China is an adversary, at least in some ways, that you want to move the supply chains closer to home. Like I get that, right? I get the geopolitical implications of that and the rationale of that. Um, but U.S., Mexico, Canada. I mean, the USMCA was that, NAFTA was that. It just makes a lot of sense that you can argue that's a super region. And even if you bring the supply chains to those three regions and you do it in a smart way that like American workers are not displaced or what have you, um, to me that's a no-brainer. And hopefully there's enough sane people in the administration or practical people that that's what will prevail. It certainly prevailed the last time. It's obviously in his nature to stir things up and to put people on their back heels. But I would imagine that there'll be some new version of both of those trade deals. I certainly hope so because the regions are too inextricably linked for it not to be. And you cannot, like, you don't have enough of a workforce to even do it. And so I'm hoping for the best that that's what happens. But
Right.
if anything, we live in unpredictable times.
We do.
But I am heartened by the fact that what promised 9 months ago to be a storm of trade tensions and tariffs turning into a trade war and turning into a capital war. Really, you don't hear much about it anymore. And so I think that hopefully that chapter is largely behind us.
Okay. There's some nail biting, I think, going into next year on that
Yes,
one, but
yeah.
we'll get there when we get there. Maybe just a couple of thoughts on long bonds and also the Fed. We've just got a couple of minutes left. But I think the discussion of whether there are impairments in the long bond space or not. You spoke to the steepening of the yield curve and some of the machinations behind making that happen. But I mean, there are some defaults. There certainly are tight credit spreads. And some will argue they only have one way to go, which is to widen. Just a couple of thoughts, if you would, on that as we round out the year.
Yeah, so the bond market has been, I would say, eerily quiet. I mean, remember 9 months ago when bond yields were going up, the dollar was going down, and we were wondering, are the foreigners going to sell?
Right.
And it really hasn't happened. The bond market has been incredibly quiet, as has been the dollar, actually. So here we are at about 4.1, 4.2 on the 10-year. We can pull up slide 13. And so far, the market is not apparently worried that we're going to have an unsustainable debt spiral, right? And maybe there's hopes that the AI boom will deliver the kind of productivity gains that we need to see to raise the speed limit, if you will, to the economy, right? Because if you look at that chart, the growth rate in the economy, the 5-year growth rate in potential GDP, is significantly higher than the 10-year yield. And when that's the case, you could argue the debt is sustainable. And if they flip, which they might in the future, that would no longer be the case. And then if you add to that some sort of financial repression where the Fed cuts more than is really justified, curve would steepen, and then the Fed would have to step in and do some sort of yield curve control, although I think in this case, reading the tea leaves from the Treasury and the people vying for the Fed chairmanship, I think the low-hanging fruit would be, again, like we said earlier, deregulate the banks, steepen the curve, and just like the 1940s, let the banks do the work for you. And I think the market is probably just sensing that whatever will happen, Bessent will pull a rabbit out of his hat.
Yeah.
And will calm the markets because he's a very savvy, seasoned Wall Street guy, and he's not like and even like Janet Yellen pulled it off back in 2023, and she's sort of like a Fed academic type. So maybe the market just figures we're not gonna fight, instead of not fighting the Fed, we're not gonna fight the Treasury, and it's probably not a bad thing to do. So
that's fascinating to sort of see what's at the back of investors,
Yeah.
kind of propelling it all forward. We wish you and your family the most wonderful time together over this holiday season, and our expressed gratitude for all that you share with us. We literally don't know what we do without you each week. So thank you very much. You're very much appreciated.
Thank you. Happy holidays to you and all the warriors out there. We'll see you next year.
Okay, all the best.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.